$74.6 billion. That's the amount the Federal Reserve injected into the banking system on December 31, 2025, through its Standing Repo Facility, the largest single-day operation in the program's history. Not during a financial crisis, not during a pandemic. On New Year's Eve, while most Americans prepared to celebrate, someone on Wall Street needed emergency cash. The official explanation? Routine year-end liquidity management, standard procedures, nothing unusual. But here's what the press release didn't mention. 5 days earlier, on December 26th, the Fed had already pumped $17 billion into an unnamed financial institution. The day after Christmas, the identity of that borrower classified until December 2027. Someone needed emergency funding while the rest of the country opened presents. Connect these two events. Record injection on December 31st. Mystery bailout on December 26th. Someone on Wall Street is in trouble, and the Fed is keeping them alive without telling anyone who they are or why. But that's only half the story. On January 2, 2026, physical silver bullion traded at $130 per ounce in Tokyo and Dubai. Actual metal, changing hands between buyers and sellers. Meanwhile, COMEX silver futures in New York quoted $71 per ounce. Same metal, same day, two different prices. An 80% premium, the largest divergence between physical and paper prices in precious metals history. Larger than the gold disconnect in 1980, larger than the London gold pool collapse in 1968. The math doesn't lie. When physical silver trades at double the paper price, one of two things is happening. Either the paper price is fake, or there's no actual metal backing those contracts. The data suggests both are true simultaneously. These two crises are not separate events. The Fed's emergency liquidity operations and the silver market disconnect are symptoms of the same underlying problem. Banks are trapped in positions they cannot close, contracts they cannot deliver, and the system is fracturing under the pressure. The timeline reveals the pattern. November 2025, the Federal Reserve removed the $500 billion cap on its Standing Repo Facility. December 26th, unnamed bank receives $17 billion in emergency funding. December 31st, record $74.6 billion injection. January 1st, China implements strict silver export restrictions. January 2nd, physical premiums explode to 80% above paper prices. This isn't coincidence. This is a sequence. Banks borrowed $74.6 billion using $31.5 billion in Treasury securities and $43.1 billion in mortgage-backed securities as collateral. This exceeded the previous record of $50.35 billion set on October 31, 2025. By January 6th, the Standing Repo Facility balance had returned to zero, all repos unwound, back to normal. Except for one detail, the unnamed bank that received $17 billion on December 26th. That loan didn't appear in the Standing Repo Facility data. It came through a different channel, a channel the Fed doesn't disclose in daily operations reports. Wolf Street analyzed the Federal Reserve's balance sheet data and noted the $17 billion injection appeared under emergency lending facilities, not the Standing Repo Facility, not the discount window, a third category that only appears when the Fed extends credit outside normal channels. This is how you identify a bank in trouble. They don't use the public facilities. They go through the back door. The timing matters. December 26th falls during the thinnest trading period of the year. If you're a bank holding a large short position in a commodity that just rallied 147% in 12 months, year-end is when your margin calls come due. Your counterparties want cash, your prime brokers want collateral, and there's nobody else trading to help you roll your position forward. So you call the Fed, and you borrow $17 billion, with the understanding that nobody will know it was you until 2027. What came next changed everything. Silver began 2025 at approximately $28 per ounce. By December, it reached $83.64, a 147% gain, the largest annual rally since 1979. Industrial demand from solar panels, electric vehicles, and AI hardware consumed 60% of global mine production. Investment demand absorbed another 20%. The math creates a problem. Total annual mine production equals approximately 1 billion ounces, 800 million ounces consumed by industry and investment. That leaves 200 million ounces for everything else, except recycling only recovered 180 million ounces in 2025. The Silver Institute projected a structural deficit of 100 to 200 million ounces for 2026. What happens when demand exceeds supply by that magnitude? Prices rise until demand destruction occurs. Except silver doesn't have demand destruction at these levels. You cannot build a solar panel without silver paste. You cannot manufacture semiconductors without silver bonding wire. You cannot produce EV charging infrastructure without silver contactors. These are non-negotiable industrial inputs. Price becomes irrelevant when the alternative is shutting down your factory. So industrial buyers bypassed COMEX entirely. They went directly to refiners. They offered premiums over spot. They locked in multi-year supply contracts. And they started hoarding physical inventory. The premium data tells the story. Shanghai Gold Exchange quoted physical silver at $8 per ounce above COMEX throughout late December. Indian buyers offered $5 premiums. Japanese dealers reported $130 per ounce for immediate delivery in early January. Dubai markets confirmed similar pricing. The entire Asian physical market disconnected from Western paper markets. Why? Because there's no metal in the West. COMEX registered inventories fell 70% since 2020, from 330 million ounces to 127 million ounces as of January 9, 2026. Registered inventory represents metal available for immediate delivery against futures contracts. 127 million ounces sounds like a lot. Until you realize January 2026, COMEX silver futures open interest equals approximately 150,000 contracts. Each contract represents 5,000 ounces. That's 750 million ounces of paper claims, against 127 million ounces of registered physical inventory, 6 paper claims for every physical ounce. And that ratio assumes nobody else demands delivery. The moment more contracts stand for delivery, the ratio explodes. At some point, the exchange cannot fulfill its delivery obligations. That's when cash settlement becomes mandatory. And when cash settlement happens, the paper price becomes meaningless. The data reveals who understands this problem. On January 7, 2026, CME Group's daily delivery report showed 1,624 silver contracts receiving delivery notices, 8.1 million ounces. JPMorgan issued 99% of those delivery notices. They delivered 8 million ounces from their house account to various stopping parties. But here's the critical detail. January open interest increased by 1,431 contracts on January 7th. New longs entered the market demanding immediate delivery. They didn't wait for March, the next major delivery month. They wanted metal now. This behavior indicates backwardation. When the spot price exceeds the futures price, the market signals immediate physical scarcity. Backwardation forces registered inventory outflows. Metal leaves the exchange vaults because physical buyers are willing to pay premiums over futures prices. John Lindow from Silver Trade analyzed the contract rolling data and noted something unusual. Open interest in February 2026 contracts increased by 1,564 contracts. Meanwhile, March 2026, open interest fell by 2,936 contracts. Traders were rolling backward from March into February and January, the exact opposite of normal market behavior. Why roll backward? Because they want the metal now, not in March, now. Even though January and February are minor months, even though rolling backward costs money, they want immediate physical possession. That behavior only makes sense if you believe registered inventory will be significantly lower by March, or if you believe COMEX will implement cash settlement before March delivery period begins. Either scenario means taking delivery now is your last chance to extract physical metal from the exchange at anything close to the paper price. JPMorgan's delivery data proves they understand this. They issued 8 million ounces in one day, not because they wanted to help the market, because they're managing their own book. Issue paper at $70, take delivery of physical at $70, sell physical at $130 in Tokyo, pocket the $60 premium. Repeat until COMEX runs out of metal or implements cash settlement. But that wasn't the strangest part. Citigroup Research estimated $6.8 billion in silver futures would be sold during the first 2 weeks of January 2026. This selling derived from the annual Bloomberg Commodity Index rebalancing. Because silver rallied 147% in 2025, its weight in the index exceeded maximum allocation limits. Index funds must sell silver futures to rebalance. Mechanical selling, non-discretionary, predictable. The banks knew this selling was coming. They positioned accordingly. Short the futures ahead of the rebalancing, cover at lower prices after index funds complete their selling. Classic front-running. Except this time, something went wrong. The physical market didn't cooperate. While paper prices fell from $83 to $71 during early January, physical premiums expanded. Shanghai premiums increased to $8. Tokyo premiums exploded to $59 over spot. Dubai confirmed similar dislocations. This created a problem for banks with short positions. You can sell futures all day long. You can push the paper price down 10%. But if nobody with physical metal will sell to you at that price, you cannot close your short position. You either deliver physical metal you don't have, or you pay the premium to buy physical metal at $130 to satisfy delivery obligations at $71, a $59 loss per ounce. How much silver are the banks short? The most recent CFTC Bank Participation Report from December 2, 2025, showed U.S. banks held net short positions of 212 million ounces in COMEX silver futures. 212 million ounces against 127 million ounces of registered inventory. The unnamed bank that borrowed $17 billion from the Fed on December 26th probably faced exactly this situation. They had delivery obligations coming due in January. They didn't have physical metal. They couldn't buy physical metal at COMEX prices because there were no sellers. So they needed cash to either settle contracts or buy physical metal at premiums and deliver at a loss. $17 billion buys approximately 131 million ounces at $130 per ounce, enough to cover a large short position. What happened next revealed the true scale of the problem. On January 7, 2026, CME Group raised margin requirements for silver futures from $22,100 per contract to $32,500 per contract, a 47% increase. Margin hikes usually happen when volatility increases, but volatility had actually decreased in early January. Silver moved from $83 to $71 in an orderly fashion. So why raise margins? Because the exchange knows registered inventory is depleting faster than expected. They know delivery demands are surging. They know the ratio of paper claims to physical metal is expanding toward levels that threaten exchange solvency. And they know that if too many contracts stand for delivery simultaneously, they cannot fulfill those obligations. Raising margins accomplishes two things. First, it forces leveraged longs to either post additional cash or close positions. This reduces open interest and decreases potential delivery demands. Second, it makes new long positions more expensive. This discourages buyers from entering the market and demanding delivery. Both effects protect the exchange and the short sellers. The timing reveals intent. When you raise margins during falling volatility, immediately after banks take massive deliveries, right before a major delivery period, you're not managing risk. You're managing the bank's short positions. The public data confirms this pattern. Every major margin hike in silver futures over the past 15 months has occurred after significant delivery demands or during periods when physical premiums spiked. October 2025, margin increase from $18,000 to $22,000. December 2025, increase to $25,000. January 2026, increase to $32,500. Each hike followed a surge in delivery demands or widening physical premiums. When you raise margins 3 times in 4 months during a bull market, you're not managing volatility. You're trying to kill the rally. You're trying to force liquidation of long positions before they demand delivery and expose the fact that there isn't enough physical metal to satisfy contracts. But even margin hikes have limits. Eventually, the physical market overcomes the paper manipulation. Eventually, industrial users bypass futures markets entirely. When that happens, the futures price becomes irrelevant. China's January 1st export restrictions mark the turning point. China produces approximately 65% of global refined silver. Not mined silver, refined silver. The metal that goes into products. China controls the refining infrastructure. When China implements export licensing requirements for refined silver, they effectively control 2/3 of global supply available to Western markets. The timing wasn't coincidental. January 1st, 2026, right after silver's 147% rally, right after Western industrial users locked in record purchase orders, right after COMEX inventory fell 70%, right when physical premiums started exploding. So, China cut off exports. Not completely. Licensing requirements allow selective approvals, but the message is clear. Chinese refined silver stays in China unless the government approves its export. This creates a 2-tier market. Metal inside China trades at one price. Metal outside China trades at a different price. The geopolitical implications are profound. Silver isn't just a monetary metal. It's a strategic industrial resource. Solar panels require silver. Electric vehicles require silver. Semiconductor manufacturing requires silver. If China controls 65% of refined supply and restricts exports, they control the Western energy transition and technology infrastructure build-out. This is economic warfare without firing a shot. Let the West build paper markets for silver. Let them create futures contracts. Let them believe the paper price represents reality. Then cut off physical supply and watch the paper markets break. The Fed's response reveals how seriously they view this problem. $74.6 billion in a single day, $17 billion to an unnamed bank 5 days earlier. These are emergency operations that signal systemic stress. Connect all the dots. China restricts silver exports on January 1st. Physical premiums explode to 80% by January 2nd. JPMorgan issues 8 million ounces of delivery notices on January 7th. CME raises margins 47% on January 7th. January open interest surges despite being a minor delivery month. Traders roll contracts backward to demand immediate delivery. Physical metal disappears from Western vaults, and the Fed pumps $91.6 billion into the banking system between December 26th and December 31st. This is what a market break looks like, not a crash. A break. When the paper price and the physical price divorce permanently. When futures contracts become unreliable indicators of actual metal availability. When industrial users bypass exchanges entirely. When banks need emergency Fed funding to meet delivery obligations, when the exchange raises margins to protect short sellers. The silver market isn't predicting a crisis, it's revealing a crisis that already started. The question isn't whether the paper price will converge with the physical price. The question is, which price will prevail? If physical supply remains tight and China maintains export restrictions, the paper price becomes meaningless. Smart money knows this. That's why January deliveries surged. That's why contracts rolled backward. That's why JPMorgan delivered 8 million ounces while simultaneously standing for delivery in other accounts. They're managing both sides of the book. Issue from house account. Take delivery from client accounts. Net result: accumulate physical metal while appearing to facilitate market liquidity. The unnamed bank that borrowed $17 billion probably wasn't hedged properly. They held short positions without equivalent physical metal. When delivery demands came due and physical premiums spiked, they faced immediate losses. The Fed stepped in to prevent default. But that $17 billion only bought time. It didn't solve the underlying problem. There still isn't enough physical silver to satisfy all paper claims. There still isn't a mechanism to create new supply quickly enough. And there still isn't a policy solution that resolves the disconnect without someone taking catastrophic losses. The Fed's liquidity injection suggests they're choosing to prevent bank failures rather than allow the system to break. But liquidity interventions don't create physical silver. They don't increase mine production. They don't convince China to lift export restrictions. They don't eliminate the structural deficit. They just delay recognition of the problem. The math is simple. 127 million ounces of registered inventory, 750 million ounces of paper claims, 6-to-1 ratio. If 10% of contracts stand for delivery, registered inventory disappears. We are watching the end of paper-silver price discovery, the same way we watched the end of the London gold pool in 1968, the same way we watched the collapse of the dollar gold peg in 1971. Every attempt to control commodity prices through paper markets eventually fails. January 2026 is when that belief broke. Physical metal at $130, paper contracts at $71. The market is voting, and it's voting for physical. How long can the banks defend the paper price? Not long. Because every defense mechanism they deploy makes the situation worse. Raise margins? Confirms the exchange fears delivery demands. Pump Fed liquidity. Confirms banks are in trouble. Allow physical premiums to expand. Confirms the paper price is fake. There is no good option. Every path forward reveals the problem. The Fed knows this. That's why they injected $91.6 billion in 6 days. That's why they won't disclose which bank borrowed $17 billion. That's why the Standing Repo Facility removed its $500 billion cap in November. They're preparing for the possibility that this problem spreads beyond silver. That's systemic risk. Not the risk of one bank failing, the risk of the entire commodity pricing infrastructure failing. The warning signs are flashing red. Record Fed interventions, mystery bank bailouts, 80% physical premiums, 70% inventory depletions, Chinese export restrictions, margin hikes during falling volatility, backward contract rolling, delivery demands in minor months. The question is not whether this breaks, the question is when and what breaks first. January 2026 might be remembered as the month that collapse began, not with a crash, not with a single catastrophic event, but with a quiet divergence. Physical metal at $130, paper contracts at $71, and a $74.6 billion Fed injection that nobody wants to explain. The system isn't breaking tomorrow, but it's showing stress fractures. And stress fractures widen under pressure. Supply deficits, export restrictions, delivery demands, margin hikes, mystery bailouts. When it does break, the paper price will be irrelevant. Physical supply will be scarce. And the only question that matters will be, did you position yourself before the break or after?